Taking a good setup in the right place at the right time just to see it go and sweep back and stop you out, and then, of course, after stopping you out to the tick, it goes right back up in the direction that you thought it was going to go, into the highs again, and it would have hit all of your targets, right? That's just mean-spirited, it's cruel, it's spiteful, it's normal market movement. Welcome to the life of a day trader, right? Hey there, John Henry here, SSFTG. Welcome to the video. If this is your first time on the channel, welcome my friend. I hope to earn your like and subscription today. In this one, I wanted to talk about some ways that we can stay, relatively solid in these spiteful, vindictive moves while not risking everything times 10. Of course, before entering any trade, you absolutely have to know your risk overall. But assuming that that part is on lock and you've got your risk in check and everything's good, then we can kind of move on. So just, before you go in, make sure you know your risk. If your entry point is having you place your stop 379 ticks away, then with that target of 1,165, that's an amazing reward versus risk, but that's also going to be inherently lower probability too. It's just easier for the market to go 379 ticks than to go about face, turn around and go 1,165 in the other direction. So probability-wise, it's just going to be easier to get stopped out in that scenario, therefore the probability of the trade is going to be reduced. You just have to make sure that your trader's math compensates for the difference. So to allow for the lack of probability in an attempt to gain some of it back, we can split our stop sizing a little bit as long as it fits our overall risk. Very important. An example, if we can risk about 1,000 or 1,100 MNQ ticks, that's about $500, $550 on a trade, then we can break that down to help our risk a little bit and bump our probability. What I mean by this is really simple. Instead of taking everything we have and going all in one shot and all out at one shot with a stop loss, we can reduce our sizing a little bit. So instead of 3 contracts, we could utilize 2, and then we could widen out a little bit. Let's use L pockets as an example. L pockets are really, really easy because they're already on my drawing tool, and it's something that if you've gone through the Day Trading Academy on SSFTG, you're already going to be familiar with anyway. They're reliable, they're already built into the measuring tool, they're already there. So I'll just split my first stop in this case to the L1, which is the 379 ticks, and L2, which is 765. Now, if I were to look at those 2 different places and go all in, all out, then 3 contracts at 379 would put us at around 1,137 ticks, at around 3 contracts, give or take. Now, with that in mind, if that were to go up and hit the target, that's 1,165 times 3, so that's 3,495 ticks. That's really solid. It's about 3 to 1 in terms of the reward versus risk, which is very nice, but it doesn't allow for any gray space. It doesn't allow for any situations where the market is vindictively comes down, takes your stop, and then goes bouncing all the way up into the highs. So are there ways that we can kind of modify the scenario a little bit to fit those areas instead? And that's where the other scenario comes in, scenario 2, and this one's going to be where instead of going in with 3 contracts, we go in with 2. But on the second contract, we increase the size of the risk times 2 on that as well. So 379 down to 765 for the target in the exact same spot. Now, with 2 contracts, 379 plus the 765 gives us a total risk of 1,144, I believe is what it was, which is basically in the exact same spot, give or take a couple ticks. It's the same thing as the other one. So with that risk perspective in mind, we now have a little bit of a different scenario, because if it hits the entry and runs straight to the target, that's great. We're up 2,330 ticks. It's not 3,000 whatever. It's closer to 2 to 1 instead of 3 to 1, but it's still a really good trade and nothing to be upset by. But if it goes down and takes out one of the stops, sweeps one of the stops, but rolls up and goes up to the target anyway, we lose 379 on the first stop location. The second stop location is down here, which still has not been hit, but the market rolls all the way up and takes out a target at 1165. So we lose the 379 initially, but we gain the 1165 on the difference, which gives us a net difference of positive 786. A gain of 786 ticks on a trade that would have normally been a complete and total loss certainly isn't anything to be upset by. That said, on those events where it is a full-blown winner, you do miss out on some of the profit too. That's the give and take of this as a relationship to trading. You got to give something to get something back. Of course, there are millions of ways to trade any market, which is literally market chaos theory in a nutshell, right? But man, it's fun finding all these little nuances and little ways that you can kind of approach them and kind of twist this piece to make it fit a little bit better there. And it's one of my favorite ways to increase probability, doing stuff like this, where you reduce risk along the way, drop your overall size to bring the overall risk down, and gives you a lot more flexibility in the trade to stay with it where it might have otherwise kind of whipped you out. Like I said, this is one of my favorite ways to, well, increase probability and also bring down the risk, lowering the overall position size, but it adds a huge amount of flexibility, and that is something I'm a big fan of. Of course, if you have any questions about it, topics for new videos, or thoughts about anything else, drop them in the comments below. I always love hearing from you all. Until the next one, thanks for watching, and we'll see you all then.